Ever feel like your financial life has these hidden switches? Flick one way, you save money, flick the other.
Mm.
Maybe not so much.
Absolutely. Especially when it comes to taxes. There are so many little corners that can make a big difference.
That's exactly what we're tackling today. We're doing a deep dive into individual tax compliance and planning. We've looked at a ton of info, how stock options get taxed, these kind of weird interest rules on loans you make to friends,
Yeah.
smart ways to handle health costs for tax breaks.
Yeah, lots of good stuff.
Our goal here is simple. Cut through the complex language, give you the shortcut to being informed, and help you spot those aha moments you can actually use. Ready to jump in?
Let's do it.
Okay, first up, something that hits home for a lot of people. Equity compensation. Stock options, restricted stock, SARs, that kind of thing. Great perk, right?
Fantastic, yeah.
But the tax side can be, well, a maze. The big thing to grasp, the real aha moment, is that the IRS really cares when they consider that stock yours, tax-wise. Getting that timing wrong can seriously change when you owe tax and how much.
Right.
So what's the deal with this readily determinable value thing? How does that set the stage?
That's really the starting point. It all hinges on whether the IRS thinks your option has a readily determinable value on the day you get it, the grant date. Basically, can they easily pin down its value right then and there?
Okay.
If the answer is yes, if it does have that readily determinable value, then boom, tax event happens right away, year of grant.
So you pay tax immediately.
You pay ordinary income tax on that value in the year it's granted. Now, the upside is no more income tax when you actually exercise the option later, and your cost basis for when you eventually sell the stock is higher. It includes the amount you were already taxed on. That can mean less capital gains tax down the road.
And the holding period for capital gains starts when?
Starts when you exercise. Oh, and if the option just expires worthless, you might get a capital loss based on what you were initially taxed on.
Okay, scenario one. Value is clear up front, tax is up front. What if it's not clear? No readily determinable value.
Right, and this is more common for typical employee stock options. If there's no readily determinable value at grant, the whole game shifts. The taxable event isn't the grant date anymore, it's the exercise date, the day you actually buy the stock.
Okay, so tax is delayed.
Delayed, exactly. And on that exercise date, you recognize ordinary income. The amount is what's called the bargain element.
A bargain element. What's that exactly?
Think of it as the discount you got. It's the difference between the stock's fair market value on the day you exercise and the lower price you paid using the option. That difference, that bargain, is taxed as regular income.
Okay, so you pay ordinary income tax on that gain right when you exercise.
Correct. And then your cost basis for the stock going forward is its fair market value on that exercise date. Holding period also starts then, and if these options lapse, you'd get a capital loss only if you actually paid something for the options themselves, which is less common for employees.
So understanding that readily determinable value piece is huge. It flips the switch on when you pay tax.
Totally.
And this gets even more interesting when we compare different types of options, like non-statutory stock options, NSOs, versus incentive stock options, ISOs. ISOs have some special rules, right?
Yeah.
Especially around holding periods for better tax treatment.
Oh, absolutely. ISOs can be really beneficial if you meet the requirements. First, for the grant itself, there are rules like it has to be exercisable within 10 years, and the exercise price can't be lower than the stock's market value on the grant date.
Standard stuff. But the holding period is the key part.
That's where the magic can happen. For a qualified sale, meaning you get the best tax treatment you generally need to hold the stock for at least 2 years after the grant date and at least 1 year after the exercise date. We call it the 2-1 rule.
2 years from grant, 1 year from exercise. Got it.
If you nail both of those holding periods, the big benefit kicks in. Generally, no compensation income is recognized when you grant or exercise the ISO, and when you sell the stock, any gain is typically treated as a long-term capital gain.
Which usually means lower tax rates than ordinary income. That's the goal.
This is definitely the goal. Now, compare that to NSOs, where that bargain element gets hit with ordinary income tax right exercise. With ISOs, you potentially avoid that entirely. Your basis is just what you paid for the stock, the exercise price.
But what if you don't meet the 2-1 rule for ISOs? You sell too soon.
Then it's a disqualifying disposition. The rules kind of snap back. Part of your gain specifically, up to that bargain element amount from the exercise date, gets reclassified as ordinary income. Any gain above that bargain element might still be capital gain, depending on how long you held it after exercise. And if you sell at a loss, it's a capital loss.
So you lose some of that special ISO benefit.
You do. Oh, and quick aside, Employee stock purchase plans, ESPPs, often have similar holding requirements and employment conditions, like needing to still be employed near the exercise date to get certain tax perks.
Okay, so the bottom line here for you, the listener, figuring out what kind of equity you have and understanding these timing and holding rules,
Mm,
it's not just paperwork. It can dramatically change your tax bill when you get or sell that company's stock.
absolutely critical planning point.
All right, let's pivot to something completely different, maybe a little unexpected. Loans.
Hmm.
Specifically, loans between, say, family members or friends.
Yeah.
Seems harmless, right?
You'd think so. But this is where things can get surprisingly complicated because of something called imputed interest.
Imputed interest. Sounds official. What's the gist?
The IRS has rules for what they call below market loans. That's basically any loan where the interest rate you're charging is less than a minimum rate set by the IRS, called the applicable federal rate, or AFR. It changes periodically.
Okay, so if I loan my brother money at 0% interest, that's a below-market loan.
Exactly. And when that happens, the IRS essentially says, wait a minute, interest should have been paid here. So they impute it. They calculate the interest that would have been due using the AFR, subtract any interest that was actually paid.
Yeah, the difference is the imputed interest.
Precisely. And here's the kicker. That imputed amount is generally treated as taxable income to the lender.
Wow, okay, so even if no cash changes hands as interest, the lender might owe tax.
That's the surprising part, yes. Let's use an example. Say Pat loans Robert $20,000. The AFR suggests $600 of interest should be paid for the year, but maybe Robert only pays Pat $200 in actual interest. The IRS would then impute the missing $400. That $400 is treated as if Robert paid it to Pat, like a gift maybe, depending on the relationship, and then Pat immediately paid it back to Robert as interest income. So Pat has $400 of taxable interest income she didn't actually receive in cash.
That could be a nasty surprise come tax time. And does this apply just to family loans?
Nope, it's broader than you might think. Gift loans between friends, family are common ones, yes. But it also applies to compensation-related loans, like between an employer and employee.
Ah, okay.
Corporation shareholder loans, too. And there's a catch-all for loans where tax avoidance seems to be a main goal. Even some loans to continuing care facilities can fall under these rules. The IRS really tries to cover situations where loans might be used to shift income or avoid tax.
Seems like a wide net. Are there ways out of this?
Yeah.
Exception.
Thankfully, yes. There are some important de minimis exceptions, meaning for small amounts. For gift loans between individuals, if the total amount outstanding between that specific lender and borrower is $10,000 or less on any day during the year, the imputed interest rules generally don't apply.
Okay, $10,000 is a key number. Any catches?
Big one. The loan proceeds can't be used by the borrower to buy income-producing assets. If they use that $10K loan to buy stocks or bonds, the exception might not apply.
Got it. What about employer or corporate loans?
Same $10,000 threshold applies for compensation-related and corporation shareholder loans. Again, though, there's a condition. Tax avoidance can't be a principal purpose of the loan.
Makes sense. Any other general exceptions?
Yeah, a few others. Things like government-subsidized loans, think student loans are usually exempt. Loans made in the ordinary course of business, like maybe that 0% financing deal on a car, certain employee relocation loans, loans involving foreign persons sometimes have special rules, and gift loans to charities, like a 501c, are okay up to $250,000 outstanding.
Okay, that $10,000 exception is helpful for small gift loans. What about slightly larger ones, say between $10,000 and $100,000? Is there any relief there? That seems like a common range for family help.
Yes, there's a very important special rule for gift loans of $100,000 or less. For these loans, the amount of imputed interest that the lender has to report as income is limited. It's capped at the borrower's net investment income for the year.
Net investment income. So dividends, interest, capital gains the borrower earned.
Exactly. And here's another helpful bit. If the borrower's net investment income for the year is $1,000 or less, the imputed interest for the lender is treated as zero.
Oh, that's significant. So if you loan your kids, say, $50,000 to help with a down payment, and they have little or no investment income that year, you likely won't have any imputed interest income to worry about, even if you charge zero interest.
Precisely. It provides significant relief for many common family lending situations where the money isn't being used to generate investment returns for the borrower.
So bringing it back to the listener, why should you care about these imputed interest rules?
Because being generous shouldn't lead to an unexpected tax bill. If you're the lender on a below-market loan, not knowing these rules could mean you owe taxes on income you never actually received in cash. It's about avoiding that surprise.
Good intentions, potential tax headache. Definitely worth knowing about. Okay, let's shift focus now to something really fundamental in tax planning.
Timing.
Ah, yes, the when factor, crucial.
It really is. It's not just what you do financially, but when you do it. Tax laws change, your own situation changes, maybe income goes up or down, start a business, approach retirement. All these things create chances to be smart about timing.
That's the essence of it. The main strategies boil down to timing your income and timing your deductions. Let's start with income.
Okay.
If you expect tax rates to stay pretty much the same, the general idea is to defer income if you can. Push it into a later year. Why? Because of the time value of money. Paying $100 in tax next year is actually cheaper than paying $100 today because you could have used that money in the meantime. Right, like the example where Jill defers $100,000 of business income and saves almost $3,000 after tax just by paying later.
Exactly. Present value makes deferral attractive when rates are stable, but what if you expect rates to go up?
Then you flip the strategy, right? You might want to accelerate income.
Precisely. Pull income into the current year if you think you'll be in a significantly higher bracket next year. Pay the tax now at the lower rate, like Jill paying 32% this year instead of an expected 35% next year on some income. The after-tax amount is higher if she takes the hit now.
Okay, so income timing depends on rate expectations. What about deductions? Same logic, but reversed.
Exactly reversed. If tax rates are stable or maybe even going down, you generally want to accelerate your deductions. Take them now, get the tax benefits sooner.
Makes sense. Get the savings faster.
But if you expect tax rates to increase, you might want to defer deductions. Why? Because that deduction will be worth more in the future when it offsets income tax at a higher rate. Like Jill delaying an equipment purchase to get a 35% deduction next year instead of 32% this year. The tax savings are bigger.
So it's a constant interplay between your income, your deductions, and what you anticipate happening with tax rates.
It really is. But there's another layer of complexity we have to mention when talking timing and deductions.
Uh-oh. Let me guess. The AMT.
You got it. The alternative minimum tax. It's like this parallel tax system designed to make sure higher income folks who use a lot of deductions and tax breaks still pay, well, a minimum level of tax.
It always feels like it comes out of nowhere for some people. How does it generally work?
The basic idea is you start with your regular taxable income, then you have to add back certain deductions or income items that were allowed for regular tax. These are called adjustments and tax preferences.
Add back, like what?
Common adjustments include things that might have significantly lowered your regular tax, like passive activity losses, maybe some accelerated depreciation benefits, and a big one for many people, state and local tax deductions. Those get added back for AMT.
Ouch. So your SALT deduction disappears for AMT.
Pretty much. And then there are tax preference items. These are things that are always added back for AMT, like interest from certain private activity bonds. You add all these adjustments and preferences back to your regular taxable income to get your alternative minimum taxable income, or AMTI.
Okay, so AMTI is usually higher than regular taxable income.
Often, yes. Like in the Janet example, her regular taxable income was $60,000. But after adding $9,200 in adjustments and $1,300 in preference items, her AMTI jumped to $70,500. Then there's a separate AMT calculation with its own rates and exemptions. You figure out the AMT liability, compare it to your regular tax liability, and you have to pay whichever amount is higher.
So even if you've carefully timed deductions to lower your regular tax, the AMT could still pull your tax bill back up.
It absolutely can. That's why when you're doing significant tax planning, especially with timing deductions, you have to consider the potential impact of the AMT.
Okay, so the takeaway here for you listening, tax planning isn't just about what you do, it's very much about when. Understanding how timing interacts with tax rates and the AMT is key to really optimizing things.
Couldn't agree more.
All right, let's talk about smart ways to spend money, specifically on healthcare. There are accounts designed to give you tax breaks for these costs, right? FSAs and HSAs.
Yes, flexible spending accounts and health savings accounts. Both let you use pre-tax dollars for qualified medical expenses, which is a great way to save.
Let's break them down. FSAs first, how do those work?
FSAs are usually offered through your employer. You decide how much to contribute for the year, typically up to a limit. It was $3,050 in 2023. That money comes out of your paycheck before taxes are calculated.
Pre-tax, okay, so you save on income tax and payroll taxes.
Exactly. It reduces your taxable income. Then, when you have qualified medical expenses, co-pays, prescriptions, dental, vision, that kind of stuff, you get reimbursed from your FSA account tax-free.
Sounds good. What's the catch with FSAs?
The main one is the use it or lose it rule. Generally, you have to spend the money in your FSA within the plan year. If you don't, you forfeit the leftover funds.
Ouch. So you need to estimate your expenses carefully.
You do. Although many employers now offer a bit of flexibility. They might give you a grace period of 2.5 months into the next year to spend the money, or they might let you carry over a small amount. It was up to $610 from 2023 to 2024, but you usually don't get both options.
Okay, so FSAs are good for predictable near-term expenses. How do HSAs differ?
HSAs, health savings accounts, are different in a really powerful way. The money is yours to keep. It rolls over year after year if you don't spend it. It can grow tax-deferred like a retirement account.
Okay, no, use it or lose it.
Yeah.
That's a big difference. What are the contribution limits?
For 2023, the limits were higher than FSAs. $3,850 for self-only coverage and $7,750 for family coverage. Plus, if you're 55 or older, you can add an extra $1,000 as a catch-up contribution.
So potentially quite a bit more pre-tax savings. Who's eligible for an HSA?
This is key. You must be enrolled in a high-deductible health plan, an HDHP. These plans have minimum deductible amounts and maximum out-of-pocket limits set by the IRS each year. For 2023, the minimum deductible was $1,500 for self-only, $3,000 for family, and the out-of-pocket max was $7,500, self $15,000 family.
So you need that specific type of insurance plan to contribute.
Correct. You can't have an HSA with just any health plan.
How do withdrawals work with HSAs?
Withdrawals are completely tax-free and penalty-free at any age, as long as they're used for qualified medical expenses.
Okay. What if you take money out for something else, not medical?
That depends on your age. If you're under 65, withdrawals for non-qualified expenses are treated as taxable income, plus you get hit with a hefty 20% penalty.
20%. Okay, so you really want to avoid that. What about after 65?
After age 65, the rule softens. If you take money out for non-qualified expenses, it's still taxed as regular income, but that 20% penalty disappears.
So after 65, it basically acts like a traditional IRA or 401k for non-medical withdrawals. Taxable, but no extra penalty.
Exactly. That flexibility makes it a really interesting retirement planning tool.
It really does. People talk about the triple tax advantage of HSAs. Can you quickly recap that?
Sure. It's unique. 1, contributions go in pre-tax, reducing your current income tax. 2, the money grows tax-free inside the account. 3, withdrawals for qualified medical expenses are tax-free. Pre-tax in, tax-free growth, tax-free out for medical. It's hard to beat.
Unmatched, really. So HSAs offer not just healthcare savings, but potentially powerful, long-term, tax-advantaged investment growth, too.
Absolutely. If you're eligible, it's definitely something to look into seriously.
Okay, let's move on to deductions again, but from a different angle.
Yeah.
Standard versus itemized. Most people just take the standard deduction these days, right?
That's true, especially after the tax law changes a few years ago raised the standard deduction amounts significantly. For 2023, it was $13,850 for single, $20,800 head of household, $27,700 married filing jointly. Plus extra bits if you're 65 plus or blind. It's simpler for sure.
So you only itemize if your specific deductions add up to more than that standard amount.
Exactly. Itemized deductions include things like medical expenses, but only the amount above 7.5% of your adjusted gross income. State and local taxes, income or sales tax, plus property tax, but capped at $10,000 per household.
That $10K cap is a big limiter for many.
It is. Then there's home mortgage interest, charitable contributions, and casualty or theft losses in federally declared disaster areas. You add all those up, and if the total beats your standard deduction, you itemize. Otherwise, you take the standard.
Okay, but what if you're close? What if your itemized deductions are like just under the standard deduction amount each year? Is there any strategy there?
Yes. This is where bunching comes in. It's a really smart strategy for people in that situation.
Bunching. Tell me more.
The idea is to concentrate or bunch deductible expenses that you have some control over into a single year. The most common one is charitable contributions, but it could potentially work with medical expenses too if you have flexibility on timing.
So instead of spreading them out, you lump them together.
Right. Let's use the Elizabeth Roberts example. She's single. Standard deduction is $13,850. Every year, she has about $7,500 in state local taxes. Hitting that $10K cap effectively isn't relevant here, but let's say $7,500 for simplicity, and $3,000 in mortgage interest. That's $10,500. She also usually gives $2,500 to charity each year.
Okay, so $10,500 plus $2,500, $13,000 total itemized. That's less than her $13,850 standard deduction. So normally she'd just take the standard.
Correct. She takes the $13,850 standard deduction year after year, but what if in one year she makes both that year's $2,500 donation and the next year's $2,500 donation? So she gets $5,000 in charitable contributions in year one.
Ah, okay. So in year one, her itemized deductions would be $7,500 taxes plus $3,000 interest plus $5,000 charity.
Exactly. That totals $15,500. Now, that's more than her $13,850 standard deduction. So in year one, she itemizes and deducts $15,500.
And then what happens in year two? She made next year's donation already.
Right. In year two, she makes no charitable donation. Her itemized deductions are just the $7,500 in taxes and $3,000 in interest, totaling $10,500. That's well below the standard deduction. So in year two, she takes the standard deduction of $13,850.
So over the 2 years, she got deductions of $15,500 itemized plus $13,850 standard equals $29,350. How does that compare to just taking the standard deduction both years?
If she'd just taken the standard deduction both years, it would have been $13,850 plus $13,850 equals $27,700. By bunching, she increased her total deductions over 2 years by $1,650, $29,350, $27,700.
Clever. Just by shifting the timing of one expense you plan to make anyway.
Precisely. It allows you to get over the itemizing threshold in 1 year, maximizing that benefit while still getting the standard deduction in the off year.
So the point for you listening is, don't just assume you can't itemize. If you're close, think about whether bunching controllable deductions like charity could push you over the edge in alternating years. It can definitely make your deductions work harder.
It's a great planning technique.
Okay, last major topic. Something that can cause real headaches if you ignore it. Estimated tax payments.
Oh, yeah. Penalties for underpayment are no fun.
Who needs to worry about these? Is it just for self-employed people?
Primarily, yes, if you have income not subject to withholding, like from self-employment, freelancing, significant investment income, maybe large capital gains, retirement income sometimes. The basic rule is if you expect to owe at least $1,000 in tax for the year after accounting for any withholding from jobs, you generally need to pay estimated taxes.
Okay, $1,000 threshold. And you pay quarterly.
Yes, the payments are generally due around April 15th, June 15th, September 15th, and January 15th of the following year for the last quarter.
How do you make sure you pay enough to avoid penalties? Is there a target?
Yes, there are safe harbor rules. You generally avoid the underpayment penalty if, by the end of the year, the total tax you owe is less than $1,000. Or if you've paid in through withholding and estimated payments combined, the lesser of these two amounts. 1, 90% of the tax shown on your current year's tax return. Or 2, 100% of the tax shown on your prior year's tax return, assuming that return covered all 12 months.
Okay, 90% of current year's tax or our 100% of prior year's tax, whichever is lower.
Whichever is lower. There's one tweak. If your adjusted gross income, AGI, in the prior year was over $150,000, $75,000 if married filing separately, that 100% threshold bumps up to 110% of the prior year's tax.
Okay, a higher bar for higher earners relying on the prior year figure.
Right. And the IRS can sometimes waive penalties for unusual circumstances like a casualty, disaster, serious illness, or death. But generally, if you don't meet one of those safe harbors, you could face a penalty.
What's a penalty like?
The failure to pay penalty is calculated as 0.5% of the unpaid amount for each month or part of a month it's late. It adds up.
Okay, so let's make this concrete. The Sarah example. She owes $25,000 total tax. She paid $22,500 through the year. Does she owe a penalty?
Let's check the safe harbors. Is the amount she still owes $2,500 less than the $1,000? No. Did she pay at least 90% of her current year tax? Well, 90% of $25,000 is $22,500. She paid exactly $22,500. So yes, she met the 90% rule. No penalty for Sarah.
Perfect. She hit the minimum requirement.
Now, this is where year-end planning becomes really powerful, bringing multiple strategies together. Look at the Rob Johnson example.
Right. He was worried about penalties from selling ISO stock.
Exactly. He's single, $180K salary, some itemized deductions. He plans to sell ISO stock for a $20,000 gain. Initially, his projected tax is about $36,276. His withholding is $32,000.
Okay, so $32,000 is less than 90% of $36,276, which would be $32,648. So based on initial numbers, he looks like he might owe a penalty.
Correct. But then he does some smart year-end planning. He makes sure his ISO stock sale qualifies for long-term capital gains. He joins a high-deductible health plan and maxes out an HSA contribution, $3,850. He makes a $5,000 charitable gift, maybe bunching it.
So he's actively reducing his taxable income using strategies we've discussed.
Precisely. These moves lower his overall tax liability. His new projected tax after these deductions drops to $34,176. That's a saving of $2,100 in tax right there.
Nice. But how does that affect the penalty situation? His withholding is still $32,000.
Here's the key. Now we compare his $32,000 withholding to 90% of his new lower tax liability. 90% of $34,176 is $30,758 charity.
And his $32,000 withholding is more than $30,758.
Exactly. By strategically reducing his tax liability through year-end planning, HSA, charity, he not only lowered his total tax bill, but also made his existing withholding sufficient to meet the 90% safe harbor rule. No estimated tax payments needed, no underpayment penalty.
That's brilliant. It shows how these things connect deductions, reducing overall tax, which in turn helps meet estimated tax requirements.
It's a fantastic illustration of integrated tax planning.
So the clear message for you, our listener, is understand those estimated tax thresholds. Know the safe harbor rules. 90% current, 100%, 110% prior.
Yeah.
And remember that smart planning throughout the year, especially at year-end, can not only save you tax overall, but also help you manage cash flow and avoid those pesky penalties.
Foresight and action really pay off.
Wow, we have definitely dug deep today.
Yeah.
We went from the complexities of stock options,
To the surprising tax traps in friendly loans,
the power of timing income and deductions, dealing with the AMT,
leveraging FSAs and especially HSAs,
optimizing deductions through bunching, and finally nailing down those estimated tax payments.
Yeah.
It really is clear that knowing the rules and planning ahead can make a huge difference to your bottom line.
It truly does. And it's
Yeah.
not just about knowing the rules abstractly, right? It's about seeing how they fit your specific situation. That critical thinking is key. Which leads me to a final thought, a question really, for everyone listening. In your own financial life, thinking about everything we discussed, what seemingly small detail, maybe something you've overlooked before, could actually unlock a surprising tax benefit or help you steer clear of a penalty if you understood it just a bit better?
That's a great question to ponder. What little switch could you flip? Food for thought. We hope this deep dive gave you a clearer map and some solid, actionable ideas. Until next time, keep digging for those nuggets of knowledge.